Welcome back. This is our last session of this unit standard. In this session, we will demonstrate an understanding of the relationship between costs, revenue, and profits. Let's look at the 5 available costing methods and how they can be used. The costing methods are LIFO and FIFO, average, latest unit cost, and standard cost. Let's look at the first and second costing methods, which are LIFO and FIFO. LIFO is an acronym for last in, first out, and FIFO is an acronym for first in, first out. These costing methods group inventory into separate quantities based on unit cost. These layers of different costs accumulate over time as your purchase price of inventory changes. Each time a receipt of inventory is recorded into the system, a new cost layer is added. This will happen even if the cost is the same as the last time it was purchased. There is no limit as to the number of cost layers added to either the LIFO or FIFO costing methods. As you record withdrawals, the LIFO method removes inventory from the last layer first. FIFO removes inventory from the earliest layer first. The third costing method is average, which is the default method used by the system. It provides a weighted average unit cost to your inventory. Unit cost is the sum of current total costs and total costs of receipt divided by the sum of current total quantity and total quantity received. The fourth method is latest unit cost, which calculates the value of your inventory based on the unit cost of the last receipt, meaning that the total cost is recalculated after each receipt. The formula used to calculate total cost is the sum of quantity received and total current quantity multiplied by the unit cost of last receipt. The last method is standard cost. This method uses a predefined unit cost for all inventories. No matter what the actual cost of a receipt, the inventory will always be valued at the predefined unit cost that you established during inventory item addition. At month's end, a comparison between actual inventory costs and standard costs are normally calculated and posted to a standard variance account. Now that we have covered costing methods, we will look at how profit markup is calculated. Profit is calculated by taking the value of total income and subtracting the value of total expenses. You make a profit when your income is greater than your expenses. And if your expenses are greater than your income, then you are making a loss. To calculate your break-even volume, you divide your fixed costs by your unit contributions margin. The unit contribution margin is the difference between your selling price per unit and variable cost per unit. Let us take a look at two types of profit before our lesson comes to an end. Economists recognize a distinction between two levels or types of profit, which are normal profit and economic profit. Normal profit is when the total revenues of a company are equal to the total costs in a perfectly competitive market. Pure profit is when the return is greater than normal profit. Profit is a natural outcome of success in meeting the wants of a client. Many small businesses determine their basic price on their costs. The idea is to set your price high enough to cover your costs and still make a profit, which is calculated by taking your total costs and adding a markup. We have come to an end of our lesson. I hope you had a great lesson. If you feel like you misunderstood something, please go and read your learner guide. It will also help you to see the different formulas and how the calculations are done.